Hello and welcome to my MBA brand analysis. My name is RajuAcharya, and over the next several minutes I will walk through a strategic analysis of Tesla Inc. The company with a mission is to accelerate the world's transition to sustainable energy. Tesla is one of the most studied brands of our era, and today I'll show why it remains a defining case in marketing strategy and why it now stands at a critical inflection point. Here's the headline. In 2025, Tesla delivered about 1.64 million vehicles and generated roughly $94.8 billion in revenue. Both figures are significant, but both declined year over year. Revenue fell about 3%, marking the first annual revenue decline in Tesla's public history, while deliveries dropped 8.6%. Total gross margin held near 18%, and the automotive margin, excluding regulatory credit, actually rebounded to 19.2% in the first quarter of 2026. Tesla still commands about 46% of the US EV market, but in 2025 it lost the global battery electric crown to China's BYD. My thesis is this. Tesla's product-led advertising-free brand model built extraordinary equity, but the 2025 decline signaled that Tesla must evolve from mission-led scarcity to a more disciplined, multi-segment growth engine anchored on energy, software, and quality. A quick snapshot. Tesla was founded in 2003, went public in 2010, and is headquartered in Austin, Texas, led by CEO Elon Musk. It operates across three segments: automotive, energy generation and storage, and services, with products including the Model 3, Y, S, and X, the Cybertruck, the Semi Plus, Powerwall, Megapack, and Solar. I chose Tesla for four reasons. First, its defining case of product-led advertising-free brand building. For most of its history, it is spent roughly zero on traditional advertising. Second, it is an inflection point. Its first ever annual revenue decline coincides with losing the global EV crown, ideal for strategic analysis. Third, it spans every concept in this course: segmentation, positioning, digital marketing, founder brand, competitions, and customer experience. And fourth, the data is rich and transparent, from SEC filing to ID power studies, enabling a rigorous evidence-based analysis. Thank you. Now let's look at the market. The EV market is large, growing but shifting. Global battery electric sales reached about 13.7 million units in 2025, up roughly 27% year over year. So demand is still expanding, but geographically China dominates with 15.3 million new energy vehicles, while the US market actually shrank to the first time to about 1.28 million units. As the chart shows, Tesla delivered 1.64 million battery electrics, is still enormous, but BYD moved 2.26 million. Tesla holds about 46% of the US market, yet its European share fell to roughly 1.4%, and price competition is intensifying. Aggressive price cuts are eroding industry margin across the board. Tesla's segmentation strategy has evolved. Originally, it used a concentrated niche strategy targeting only high-income, tech-savvy adopters willing to pay a premium for the idea of sustainable performance. As the market matured, Tesla shifted to a differentiated multi-segment approach. Today, we can identify four core segments: early adopted and tech enthusiasts, high-income buyers in coastal metros, want innovations, performance, and status, and gravitate to the models S, X, or Cybertruck. The premium mainstream, professionals and families who want a range, safety, and lower total cost of ownership (TOC), served by the Model Y and Model 3 long range. Value conscious mass market buyers want affordability and reliability, served by the Model 3 rear wheel drive, and eco emission buyers driven by a value. Combine a Model 3 or Y with Powerwall and solar. A key insight: Tesla buyers base is aging. There are now more buyers in the 50s than in their 20s, pushing the brand to broaden from enthusiastic to mainstream value-driven segments. Let's look at the competition. In 2025, BEV deliveries, as per this chart, it's showing that SAIC has 0.68 million, and highest is BYD, which is 2.26 million, and Tesla 1.64 million. The key competitors and positioning: BYD China, new global BEV leader with 2.26 million deliveries, with vertical batteries and low cost scale, expanding export. Then comes Geely, SAIC, BW Group, Ford, GM, Rivian, Lucid. Lucid actually produces a premium US EV challengers. This positioning map plots price against technology and innovation. Tesla sits in the premium but accessible high technology quadrant, what I would call the premium mainstream gap. Lucid and Rivian occupy highest price premium niche, while BYD and Geely cluster in the low price but increasingly high technology zone. Legacy players like Volkswagen, Ford, and GM sits in the mid-range. Tesla's differentiations rest on software, full self-driving, over-the-air updates, the supercharged network, and deep vertical integration. The risk is twofold. BYD attacks from the low price, high-tech corner, and Tesla's brand increasingly tied to one founder's person. Now to Tesla's marketing strategy. For about 19 years, Tesla spent roughly zero on traditional advertising, reinvesting heavily in R&D rather than paid media, far more per vehicle than legacy automakers. The playbook rests on four pillars. One, product as advertisement. Second, founder personal brand. Third is community and word of mouth. And fourth is direct to customer model. The inflection in 2023 marks signal Tesla would try a little advertising, a historic reversal as competitions and slowing demand pressure the model. Tesla's digital marketing is organic. First, on social media, X, formerly Twitter, is the flagship, mocks real-time teases and replies, drive viral on media, while YouTube hosts product films, and TikTok and Instagram carry fan-generated content. Tesla spends minimally on paid social media. Reach relies on conversation velocity, not ad spend, which is positive. Brand equity is heavily concentrated in one founder's social persona. A single point of failure for reputations and demand. Yeah, actually, this chart tells Tesla's recent story. Revenue grew from $53.8 billion in 2021 to a peak of about $97 billion in 2024, then declined to $94.8 billion in 2025. The first annual revenue drop on record. Deliveries tell a similar story. They peaked at 1.81 million in 2023 and have now fallen 2 consecutive years to 1.64 million. What the number says? Declined by -3%, and second straight decline on deliveries by -8.6%, and energy segment revenue growth by positive 26.6%. That's the new engine. On customer insights, satisfaction and feedback, we have strength and concern. The strength is on the positive side. J.D. Power's 2026 study ranked the Tesla Model 3 first in US AV ownership, with the Model Y close behind. Tesla was unofficially ranked third in initial quality and first in EV experience. And critically, Tesla's over-the-year model resolved about 98% of its 2025 recalls without a dealer visit, a genuine loyalty level. The concerns we have are NHTSA scrutiny has been recurring. The platform breaking probe covering 695,000 cars and a power steering problem covering 376,000 were both recently closed. The Cybertruck has faced reliability issue. Based on this analysis, I offer the recommendations. First, diversity beyond the founder personal influence. Tesla should build an institutional brand, voice. Tesla-owned content executive spokesperson and structure companies to reduce single-person reputation risks while expanding major paid media, which it already began piloting in 2023. Second, accelerate the energy and software engines. And third is defend volume with an affordable model and quality. Tesla should launch a sub $35,000 vehicle to counter BYD and Geely in the value segment, pair with sustained OTA drive quality. 98% of 2025 recalls fixed over the year to convert mainstream buyers who increasingly rely on benchmark like J.D. Power. To conclude, Tesla built one of the world's most valuable brands with almost no traditional advertising, a master class in product-led, founder-driven, community-amplified marketing strategy. From mission-led scarcity to disciplined multi-engine growth, the 2025 inflection, first ever revenue decline and loss of the global BEV crown to BYD shows the old playbook is no longer sufficient as the market matures and competition intensifies. The path forward de-risk founder dependence, scale the higher margin energy and software business, and defend volume with an affordable, quality proven model. Tesla brand remains its strongest asset. The strategic task is to convert that equity into diversified, sustainable growth.